Well, last week was all about earnings from NVIDIA and concerns over the AI trade. But now that earnings season is winding down, investors will have to look at other sources of data for direction. Let's get some ideas now from Kyle Taylor, wealth advisor and portfolio manager at Tridelta Private Wealth. Kyle, thanks as always for joining us.
Thank you.
Okay, so what are we looking for going into the new year?
Well, I do think NVIDIA's earnings last week did a bit to calm some of the concerns over the AI trade, but sentiment is shifting and volatility, I think we can expect to continue. To the many AI investors out there, though, I would say that any long-term investment theme that you think is here to stay, it will have periods of good times and periods of bad times, disappointments, and I think you can either look at those opportunistically or you can look at them as a time to panic and buy into something else that you understand. Really, towards the end of the year, I think you mentioned it, there will be a bit more of a focus on some of that lingering U.S. economic data. Tuesday and Wednesday of this week, we'll see some reports that give a little bit more light into how the consumer is doing. But in terms of where I think that there are some things to be aware of and opportunity is, on something that's been well covered has been the level of concentration, particularly in the U.S. But I know we have some of the same issues just with different sectors here in Canada. Mm-hmm. But the U.S. healthcare has been something that your last guest talked about. It's something that I've actually talked on the show about quite a bit this year, and it finally seems like we're seeing signs of life there. I bring that up because there are entire cohorts of the market that are maybe less appreciated. It's still pretty reasonably valued, carry pretty good yields, and healthcare in the U.S. is something that we've certainly seen a lot of prospect in.
I was like, it's not really having a bad year, is it?
Well, not anymore. The last 2 months has been one of the best performing sectors in the U.S. Notably, actually, just last week, it was Eli Lilly became only the second ever non-tech name to reach a $1 trillion valuation. And they did that with some of the stories around obesity and the diabetes drugs that are out there and that they're capitalizing on. But yeah, over just the past 2 months, they're up 14%, but still the sector as a whole, I believe, is up about 11% year to date.
So is there still some deals to be had, do you feel?
I do, yeah. Particularly, I think if you're an income investor, I mean, you have Bristol Myers that's still trading at an over 5% yield and in a single-digit price earnings. We own Pfizer, Johnson & Johnson, Bristol Myers again, Eli Lilly, United Health. I still think that there is room in that space and some catch-up and some really just appreciation of the fact that the headlines earlier in the year around bringing U.S. drug prices down, some of the headlines from the U.S. administration weren't as negative as we maybe originally thought just a few months ago.
And I just want to go back for a second to the data coming up. How is it important, the data that we're going to see this week? Could it have a real swing on the market, real impact on the markets? And also thoughts on what we're going to see for a Fed rate cut. Will we see one? And same with up here.
Well, I think there's been all year there's been a big divergence between how investors are feeling about the world and how consumers are feeling. Particularly in the U.S., there's a University of Michigan consumer sentiment survey that I follow pretty closely. And they're actually reporting consumer sentiment worse than it was in the depths of 08-09, which is pretty shocking. I know that the stock market is a forward-looking beast, but I think we have to appreciate what the consumer is actually seeing. Higher income cohorts they've continued their spending at large, but some of the lower income segments, I think that's where a lot of people are taking their cues from some of the retailers like Walmart, Dollar General, Dollarama, which have had really great years. And I think that sort of speaks to some of the reason why, as people look away from maybe some of the brand name products that are out there. In terms of interest rates, I think I wouldn't be surprised. I do think it could go either way in December. And if it does go where they opt to hold things steady, I think they cite the lack of data availability from the U.S. government shutdown. But I do think we'll see at least one before the end of the first quarter.
All right. And I'm dancing a little bit, but getting back to the investing, what to look for. You feel one of the kind of the worst things you can do is just simply buy the index.
I do. I mean, I think there's a time where being a passive investor is okay, but I think we're in an environment today where if you're not being active, you're certainly could be jeopardizing your portfolio on the downside. I mean, if you are an index investor and that index falls 20% and your portfolio falls 20%, it's not a one-to-one. You need to rise 20% to get back to where you were. Just the way the math works out, you need to rise 25% just to get back to where you were prior to that correction. If you experience only half, if your portfolio goes half of what the index does, goes down 10%, you only need to get back 11% just to be back to where you were. That's just what the way the math ends up working. And I also think that there's a lot of opportunities out there on the international side. That maybe go apart from some of the U.S. names and U.S. concentration. I think a lot of people today, even if you're buying a global equity fund because you want some more international exposure, well, most global equity funds have between a 50 to 60% weighting in U.S. names. I think you have to go more international, excluding North America. And there's a lot of reason to do so. I think particularly in Europe, one of the things that's driven the U.S. rally of the previous years coming out of COVID has been a continued emphasis on fiscal spending. Everybody spent during COVID, but post-COVID, the U.S. really stood apart in terms of their spending to continue to prop up the economy. A lot of other nations didn't follow that and focus much more on bringing those deficits down. Europe is finally, and it's been evident this year, is there's been a notable shift towards spending. Germany is a very good example. I mean, with just their plans to increase on infrastructure spending, that's a doubling of what they're currently spending, and there's a lot of opportunity there for a lot of those names.
Okay, I just want to get to one more question because we want to get to some of your stock picks and staying European. NLS.pa.A. Was that how you pronounce it?
Yeah, that's an Italian utility. I know being Canadian, we know our utility companies quite well. Goes back to the electrification around some of the data centers and actually some of the AI trade even. If you just look at the expected power needs of the data centers that are being planned in Europe over the next 10 years, that already is almost the equivalent of current power demand in all of Europe. So a company like NL, it's trading at only about a 13 times earnings. That's in comparison to in the US and Canada, which are sort of in that low 20 price earnings range. They have a good prospect for continued steady growth. They have operations internationally, but I think European wise, they have quite a few catalysts for continued growth. And in the meantime, you're getting just over a 5% yield.
Okay, we're going to have to leave it at that. But Kyle, thanks as always for joining us.
Thank you.
Kyle Taylor is wealth advisor and portfolio manager at Tridelta Private Wealth.